Every 4 years, like clockwork, the stock market throws a tantrum, and right now, we might be walking straight into one. Midterm election years have a reputation, and if you don't know why, buckle up because history has some very loud opinions. The core issue is simple. Political uncertainty makes markets nervous, and nervous markets do unpredictable things. Think of it like a restaurant where the chef might get fired halfway through your meal. Nobody orders the expensive dish when the kitchen is in chaos. We're talking about a pattern that stretches back decades, where the average midterm year pullback has historically landed somewhere around 17 to 19% from peak to trough. That's not a blip, that's a full-blown check your portfolio once and then close the app kind of moment. The catalyst is usually a cocktail of policy gridlock, shifting congressional power, and the Federal Reserve doing whatever it wants regardless of the political calendar. When legislative momentum stalls, corporate earnings guidance gets murky, and murky guidance is basically kryptonite for investor confidence. What's almost poetic is how each midterm cycle starts with the same optimism, pundits calling for smooth sailing, analysts raising targets, and then somewhere around the second or third quarter, the whole narrative quietly unravels. The headlines that once screamed bull market start whispering wait and see. Psychologically, this is where retail investors tend to break. The uncertainty isn't just financial, it's existential. Because when your portfolio is down 15% and the news cycle is on fire, conviction evaporates faster than a crypto promise. But here's what the pros quietly know. The fear itself is usually the signal. Going back to 1946, markets have declined in virtually every midterm year at some point. Yet the 12 months following a midterm election have historically been among the strongest of the entire 4-year presidential cycle. The pattern is so consistent that strategists literally call it the midterm magic recovery, which is either reassuring or deeply suspicious, depending on your worldview. The volatility isn't random noise either, it's structural, driven by the fact that the sitting administration typically front-loads stimulus and spending in the first 2 years, leaving the midterm year starved of fiscal fuel. It's like a rocket burning through its best propellant and then coasting, except coasting at 30,000 feet with turbulence. One common misconception is that midterm volatility means you should go to cash and wait it out, but the data absolutely destroys that instinct. Missing the 10 best days of any given year can cut your annual return nearly in half, and those best days almost always cluster right inside the worst periods of uncertainty. The practical lesson here is not to predict the bottom, but to have a plan before the drawdown starts, because nobody thinks clearly when they're watching red numbers in real time. Sizing matters more than timing. A smaller, disciplined position you can hold through a 20% drop beats a full conviction bet. You'll panic sell at -12. There's almost a dark comedy to it every midterm year. A new generation of investors discovers that markets don't care about your feelings, your timeline, or your perfectly reasoned thesis. The market will shake you out of a good trade just because it can, and that humility is the tuition you pay to eventually make real money. The broader cycle here is almost mundane once you see it. Fear peaks, capitulation happens, institutional money quietly accumulates, and then retail investors pile back in near the top. Same story, different decade. Community traders and seasoned allocators both point to the same wisdom. The midterm dip is a feature, not a bug. Discipline and position size are the only two variables fully within your control when macro forces are swirling around you like a policy tornado. Process overprediction every single time, because the investor who survives the volatility with dry powder intact is always better positioned than the one who was right but over-leveraged. At the end of the day, whether markets drop 15% or 25% in a midterm year, the rational response is the same. Have a framework, stick to it, and let the undisciplined investor be someone else's cautionary tale. Comfort with any outcome isn't apathy, it's the result of actually doing the preparation work beforehand. Whether you're looking to build wealth through the market cycles or park capital in something more tangible like real estate, we can help you find your footing. Check out our links in the description below for real estate investing, home contracting work, and finding the right lenders to get you started.